Hello, everyone. Welcome to today's live market analysis webinar with me, Fawad Razaqzada, market analyst with Think Markets, and my colleague Victor. Hello, Victor.
Hello, Fawad. What a start to the week we had yesterday.
It has been crazy, hasn't it? The markets have been so volatile. This is the sort of times that traders and analysts like ourselves we look forward to the most, and we got plenty of volatility in the markets, and we'll discuss all of that in a minute or so. Let's just quickly go through the usual risk warning in front of you.
Yeah, we just wanted to share with you that these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. This is just a discussion about the markets. It doesn't involve any investment advice, so be wary of that while you're listening to this live or through YouTube.
Indeed.
On our Think Markets page.
Yeah, spread betting and trading CFDs carry significant risks, and it's not they're not suitable for all investors. So please bear that in mind. And with that out of the way, we can start the webinar. So we had quite a bounce, didn't we, in the markets yesterday? This is the Nasdaq 100.
Well, yeah, we had quite a bounce after shedding 4.5% in the Nasdaq.
Look at that. The Nasdaq actually ended up the day 0.66% higher.
Yeah.
Was it down like 5%? Did you say?
Well, almost 5%. It was down 4.5%, I think.
So from the previous day's close to just over
almost 5%.
Almost 5, yeah. And then from the low, we bounced to where more than 5% from the low to where it closed. Futures have fallen back. So this is the CFD of the Nasdaq 100. Futures have fallen back. We are trading back inside yesterday's range. So we're not totally out of the woods yet, but this is the hammer candle I drew in my article I shared yesterday. Let me just bring that. Think Markets. I think it was somewhere here. Market analysis. Yeah, I think it was this article. So everything sold off, and I said, we might see a bounce off the lows, and this kind of a candle is what the bulls would like to see, which is almost exactly what happened here, but we didn't quite take out the previous or this resistance level here, the red line. Still, it was a very impressive bounce, and we went back above the October low. And the RSI relative strength index was quite oversold. So there's two ways to see this. First, obviously, it was an oversold bounce. No doubt people who had shorted this, they took profit and the market closed higher. The other way to see this is this could possibly be a reversal pattern in the making. I mean, it doesn't necessarily have to go all the way to a new record high. But as a minimum, perhaps we may have seen at least a short-term low in the market. So we may see some sideways price action in the next few days, or maybe a little bit of a recovery towards 15,000 in the Nasdaq, or even higher in some of the other indices. But you're not very convinced that this is the end of the sell-off, are you, Victor?
Well, you know me very well. The way the other way to see this is a bootstrap. How far this bootstrap can go, I have no idea. But considering the fact that tomorrow we have an FOMC meeting, I feel like we could get an answer to that quite soon. What's going on tomorrow?
We have actually two central bank meetings, haven't we? Bank of Canada as well.
Yeah, we do. But aside from Canadian dollar traders, I don't think many will pay attention to that. What all of us are going to pay attention to is what is the Fed going to communicate after its meeting. There's been discussion, market chatter, if you want to call it, that after this sell-off happened, the Fed is going to to taper the expectations for a rate hike.
Taper expectations for a rate hike. Is that because the market sold off?
Yeah. So basically, you see what happened here as the market started selling off more aggressively.
Yeah.
The yield on the 10 years started dropping.
Yeah.
So we haven't reached any levels that would signal a reversal in the rise of yields. However, the chatter in the market, at least those, I guess some desperate bulls are have started this chatter, and they feel like the Fed could dial down their tone, their tone for aggressive rate hiking.
Rate hikes.
I don't really subscribe to this view because it doesn't make sense for the Fed to be reactive even before they started acting. So let's see the first rate hike, and then if markets are overwhelmingly stressed, then I guess, yes, we could see the Fed start to dial down the expectations for rate hikes this year.
Yeah,
something that has happened in the past.
In the past,
in 2018, if I'm not mistaken.
Right.
The Fed signaled 4 rate hikes. Well, they managed to raise rates once.
Yeah, the Fed always says that they don't target any specific stock market levels or whatever. Obviously, that's not true.
So they say.
So they say. But I think another way to see this is perhaps even if the Fed does not deviate from its expected rate hike path, it's possible that the market may have kind of, if not fully, but at least partially, priced in a rate increase with this sell-off. So,
yes, definitely. The rate increase, one rate increase is certainly priced in.
Yeah.
The question that's on everyone's mind is
could we have more?
Basically how many times will the Fed be able to raise rates before the market breaks and sends the Fed's intentions into a tailspin?
It looks like the market has already broken without even a lift off yet.
Yeah.
First rate hike.
We just well, the consensus is pretty much set in stone that at the next meeting of the Fed in March, we're going to get that rate hike. Now, if you look at the across different asset classes, I would say that there is a pretty big discrepancy. The dollar is rising, so the dollar is liking the fact that we're going to get a rate hike. At the same time, gold is rather bullish in the past couple of weeks. Shall we attribute that to the rising geopolitical tensions? What do you think?
I think at least partly that, but also inflation. Don't forget inflation. You know, it's one reason why people buy gold is to hedge against inflation. Massive reason. And gold has actually proven that yes, it is an inflation hedge, and it has managed to hold its own relatively well compared to most other risk assets. in the last several months, weeks even. And in the face of rising inflation and rising dollar and rising yields, gold has managed to climb higher. So usually rising inflation level means that interest rates will be hiked, which is something that is not necessarily good for gold. But I think investors are thinking differently this time. That a little bit of a rate increase is not going to materially impact the direction of gold prices, and so they've been buying the dips. The precious metal is holding itself quite comfortably now above the 200-day, which is still rising, making higher highs and higher lows. Yes, we haven't exactly broken out of the current ranges, but on the weekly time frame, we are starting to build a base above this long-term bullish trend line, which is significant. And we have broken from this bearish channel or bull flag pattern, depending on your view of it. We are starting to edge higher. So obviously, this is not an indication that prices will necessarily skyrocket from here, because who knows what's going to happen next. But at least from a purely technical perspective, this is the sort of price action that the bears would hate to see. So
certainly it's been a slow grind higher. That that having the right conditions could greatly accelerate it. So
so gold is looking decent. And you mentioned the markets are looking quite mixed, and I was just bringing the ETF charts of the financials earlier.
All right.
This is the SPDR Select Sector Fund financial. If you look at the financials, we had the really strong rebound of the 200-day moving average. Now compare this to the S&P or to the Nasdaq. Where's the Nasdaq gone? On the Nasdaq, the 200 days over here somewhere, and the rebound happened well below it. So that shows that financials have been doing better than technology, which is not a big surprise because of the rising yields. Which means that when yields rise, obviously it's good news for banks because they can charge higher interest. Which means that when it comes to trading or selecting these indices as a trading tool, you want to focus now on markets that make fundamental sense to buy the dips in. Whereas rising yields should mean the Nasdaq or technology sector in general should remain under pressure. This is therefore a market that you would like to perhaps look to sell into the rallies. But if you are bullish on the stock markets, then I would argue that something like the FTSE, which contains lots of financial stocks and commodity stocks as well, like miners and oil majors, etc. Then the FTSE is one that you could perhaps look to look for buying opportunities in. Obviously, this is not a trade. It's not trade advice or anything like that. Just really pointing a fact that that financials have been performing better because of rising yields. So that's why the falls in the FTSE has not been as significant as the US indices. The FTSE is still holding above the 200-day moving average. But it has turned negative on the year now. So perhaps if you're looking to buy the FTSE, it may make sense for to wait just a little bit longer for the market to go back above the closing price of 2021, so that it turns back to positive, and then thereafter you could perhaps look to buy future dips. But on the hourly, FTSE has shown some stability like all the other major indices. Let's just see if we can climb back up and above that purple level that we saw on the daily chart to lift back into the positive.
So another point that I wanted to make is that generally the way people see when does the Fed reverse course on their rate hiking cycle is when there is market stress. So I don't see any market stress on an institutional level at this point in time.
Right.
I feel like during the past couple of weeks, mainly individual investors who have been all into meme stocks and other
Cryptos.
junk like that are getting pummeled, punished, and
Yeah.
screaming and shouting, yeah, like the Fed is going to come in any minute and save us. Well, the Fed only saves its friends on Wall Street, guys. So
Yeah.
don't really bet on that.
Indeed. Should we
We
look at
don't
some?
have any systemic, we are not hearing about a systemic a breakdown of a certain fund or something like that happening. So yeah,
Yeah. This is
not much
the.
to worry about for the Fed at this point in time. I still feel like it.
Do you reckon?
Yeah, yeah.
Yeah.
Well, I mean, we're back to to the lows we've seen in when September. I don't know.
Yeah.
Such a crisis.
Yeah. So it's been we did see a bit of a sell off in the stock market, but it hasn't been very strong. Well, it has
Yeah,
been strong in a very short space of time, but you know the sell off hasn't taken us to like lows that we saw like last year or the year before.
yeah.
So it could just be a small correction before we see more gains or whatever. But yeah,
So
just
let's see.
focusing. Yeah,
Let's move on to the FX market,
FX
and
markets. Yeah.
the yen has really picked up some
Mm-hmm.
steam after this sell-off started.
Yeah. So previously we were expecting the retest of this blue area to hold, and although we did get a small bounce of it on this particular day,
Yeah,
didn't really quite take off because obviously Japanese yen is a safe haven currency, and when the stock markets go in a bit of a turmoil like they did, people went long the Japanese yen against everything, including the US dollar, even though the
yeah,
US dollar managed to hold its own very well against other currencies. But against the Japanese yen, it wasn't as strong because the yen is the ultimate haven currency in the FX markets right now. Where do we go from here? That's the key question. And I reckon we are still headed higher,
yeah.
regardless of what the stock market does, because ultimately it's a question of which central bank is going to be more aggressive in tightening policy. Is it going to be the Federal Reserve or the Bank of Japan? Yes, although some of those
Right.
expectations may have been dialed down, as Victor mentioned earlier, but the Fed is still head and shoulders above the rest of the world, major central banks, including the Bank of Japan, especially the Bank of Japan.
Right.
And so for that reason, I reckon that the long-term trend is going to remain in place. Yes, in the short term, I'm not very sure now what's going to happen, but the longer-term trend is still going to remain bullish, in my humble opinion.
Do you share this bullish view on the dollar across other currency pairs like the euro and
Certainly
the pound?
against a few other ones, I do. Certainly against the euro. We'll cover the euro in a minute or so. But interestingly, the Swiss franc has come to life today, as in it's sold off,
Yeah,
and that has caused the dollar Swiss to rally. And I wonder if this is because of a rebound in the euro Swiss. Yes, the euro Swiss has bounced back of the lows. So
yeah,
Euro Swiss has been under pressure because of the stock market sell-off, but perhaps it has created a bottom pattern here. We went through the previous low and we bounced from there quite strongly yesterday, like the stock markets, and we are holding the breakout. So this is possibly a case of a false break reversal pattern or a double bottom or whatever you call that. Interestingly, note that the RSI has also created a positive divergence, whereas price made a lower low, the relative strength index made a higher low, which is an indication that the bearish trend is weakening,
right.
and it's a warning sign for the sellers that perhaps rates may have reached a bottom or about to. We still need to see obviously a decisive breakout, and the confirmation would be if we get a higher high above this high now. So if we break that, then we will have our first higher high in place following the move below this low. But going back to the dollar Swiss, dollar Swiss spent a few days below the 200-day, but it's kind of stormed back to life. Still not out of the woods like the dollar yen, but ultimately I reckon the dollar Swiss is going to create a massive breakout when it happens, whenever
Right.
that might be. Because if you look at the weekly time frame, the bearish trend
There's
line,
this
yeah,
pretty massive trend line that
yeah,
has been going on since 2019. Wow.
yeah, April 2019. And
Yeah.
since that time, remember, like a lot has happened, including the Fed becoming uber hawkish from being relatively hawkish before.
Yeah.
I mean, since the end of pandemic, since the towards the middle of last year, when the Fed was still not very hawkish, but it was indicating to the market that it's starting to kind of withdraw some of its support. But then at the turn of the year, or near the end of last year, it turned quite hawkish. So that hawkishness is not being reflected in the dollar Swiss
Yeah.
yet, but I think it's about to, and very soon.
All right.
Because that's definitely something to keep an eye on.
Yeah.
Euro dollar. So euro dollar, we were previously mentioning the importance of the area between 114.50 to 115, as you may recall from our previous webinar. It's kind of proved to be the case, because if you look at the daily chart, we broke above the trend line momentarily, tested that area, and as we had indicated, the market has sold off.
Yeah.
So that's not a major surprise, is it, Victor?
Yeah, not really. As we have been re-emphasizing over and over again, the dollar is still not the one to go down.
Mm-hmm.
That can only happen when the Fed reverses course.
Yeah.
And it hasn't even started to pivot yet. I mean, it did pivot, but it hasn't started to move.
Right.
So yeah, you should definitely hold your horses if you want to bet against the dollar at this point in time. I just don't feel like it's the right time.
No. So do you reckon that this has now paved the way for the 110 level that we were looking for previously, which is the base of the previous breakout in May 2020?
If we don't get any surprises from the Fed, meaning that if they stick with their commitment to aggressive tightening, well, for rate hikes is not that aggressive really, but when inflation is at 7%, but still, yeah, in the current conditions, this is aggressive tightening, and this is what the market currently expects. Aside from some doubters that have been expressing the view that, yeah, guys, watch the Fed tighten while the stock market is dropping like crazy, like yesterday. But yeah, yesterday we marked about 18% correction in NASDAQ.
Yeah.
At the bottom. We're still not in bear market territory in the NASDAQ. I doubt.
Which is 20%?
Yeah.
Yeah.
I doubt that the Fed is going to be deterred if we even see that the 20% level. So
yeah, around 18% from the all-time high.
Yeah. So yeah, bear market is not a problem. I mean, NASDAQ bear market with all those growth stocks flying high at valuations that are, well, to any investors with a lifespan of above 2 years, he will tell you that those valuations have been are unsustainable, were unsustainable.
The thing is, if for as long as the whole of the stock markets don't sell off and go into a bear trend, a prolonged bear trend, then the Fed is not going to be too deterred.
Yeah, and if we look at the other indices, they're not far from key levels, but again, like those levels are merely what 10 or 15% below all-time highs. In the case of the Dow, I guess it's about 10%, probably a bit more, but
we got to 10% yesterday, and by the close it was just 6.5%, just over 6.5%. So we're not too far off the record highs on the Dow. You'll get to see these kind of corrections every now and again in the course of a bull run. Whether or not this is a the start of a long-term downward trend because the Fed is now tightening remains to be seen. But I reckon we will see a period of consolidation in the stock markets in the US. I don't necessarily think that we will get significant further gains in the long term, in the short to medium term.
Right.
But consolidation wouldn't be a bad thing either, because this will allow the indices to work off their overbought conditions on the longer term chart. So this is obviously oversold on daily, but if you look at it on the monthly, we are still at overbought level. So a bit of consolidation should be a welcome sign for the monthly chart. Let's go back to the currencies, shall we? Because we did talk about the euro dollar, and 110 is our ultimate objective, but the immediate target now for me is the liquidity that will be resting below the November low at 118 at 111.86, right? So that's where I think there's going to be lots of stop orders resting from people who went long the euro dollar, and I reckon given the false breakout that area is now in sight for the bears. So 111.86 is the level to watch on the downside. That's the first target. What might happen there? We might see a small break below and then a quick reversal. Should that happen, that would be a bullish sign. But if it holds below the November low, then 110 would be the next obvious target. Any other particular currency pairs you're eyeing?
Yeah, let's have a look at the pound. It's been a wild ride for the pound bulls. The test of that trend line that we mentioned 2 weeks ago at 130, just above 137, failed, and boy, did it fail well.
And the 200-day convergence as well there.
Yeah. So the first major central bank to hike rates is allegedly on a path to hike more. However, the last macroeconomic data that we saw from the UK was rather disappointing retail sales number. For the final month of last year. That definitely put a dent into the expectations on part of the market participants, whether this is a sustainable. I think it was last week.
Retail sales, minus 3.7%. We had this one. GfK consumer confidence also hit. And also the latest manufacturing PMIs both missed expectations from the manufacturing. The latest purchasing managers indices from the manufacturing sector and services both disappointed expectations. And we have the Bank of England next week, haven't we? On February 3rd.
Yeah. So the expectations for that meeting is for the Bank of England to state that.
Well, actually, I read somewhere that expectations about a rate increase has gone up since a few weeks ago, because the UK has eased some of its COVID-related restrictions.
Oh, right.
Yeah, so some major banks call it
Are calling for a rate hike.
Well, some say that it's now a flip of a coin now, whether or not they will hike. But certainly by March, I think they're expected to raise rates by an additional 25 basis points to not 0.5%. So the probability of a rate increase in February has definitely increased. So it may be that that they will do it or they won't, but the uncertainty has increased around their decision. Previously, it was going to be a hold, but the market is no longer very sure whether it will be a hold or a hike next Thursday. The pound is not really showing that kind of.
Yeah, it's not looking well, man.
Yeah.
I mean, remember when we were talking some months ago, whether the first hike would actually torpedo the pound rally?
Yeah.
And apparently that with some lag, that is exactly what is happening. Because everybody's levered to the top.
Yeah. That's one
borrow,
big
borrow,
reason.
borrow. The theme of the past two years has been to borrow as much as you can. So
yeah,
there is the result. A small rate hike is torpedoing economic prospects.
Indeed. Let's look at the crude oil, because this level here, this green line, I will show you that on the weekly chart. This was the high in 2018. We visited that high in October of last year, and we broke that level at the start of this year.
Yeah. So we did a second test, and now if we close the month below that level, we might have
the month. Sorry.
We might have a pretty decent chart pattern to work with.
Yeah, this is the inverted hammer candle that I drew in our previous webinar.
Yeah.
That if we see something like that, then perhaps that will be a signal that the crude oil market has stopped.
Right.
Have we seen something like that?
So for now, we're seeing it this week.
Yeah. and on the weekly as well, yeah.
Yeah.
We are kind of testing the previous week's low.
Yeah.
And
we could see it this week, yeah.
And price action has been quite bearish. If you look at the hourly chart here.
Yeah.
Even if, let me just put that line on the all charts. Yeah. This is the level, right, on the hourly. Even on the hourly, what's happened is if you look at this high here, we broke above it a couple of times, but in both occasions we failed, especially on this occasion. So once you get a failure like that, and a sell-off, that's a breakdown in market structure of higher highs and higher lows. So the next time the market is coming back to the area of the previous breakdown, you should be expecting a sell-off, which is exactly what happened. Since then, if I draw a couple of boxes, right? So in this move up, is when people sold into, causing this move down, right? We visited this level and then boom again. So now what we're going to do is mark out levels where price should have held as support. And one such area was this. When we broke above it here, big move up. The retest should have held. It only offered a small bounce, and then we sold off again. So just to be a bit more specific, this area right here. Yeah.
Yeah, and we did retest this morning.
And we sold off
this area, and we sold off. So yeah.
So it's showing bearish characteristic, the price action on the smaller time frames. So perhaps we may see a stronger sell-off than we already have in crude oil, and about time as well, I think, because the market was very tight previously, but that's no longer the case, is it?
Right.
The OPEC is releasing 400,000 barrels of oil per day every month.
Yeah, the only deterrent to a bear case in oil is, I guess, the situation in Russia that is still hot. And that said, remember after the whole Crimea situation in 2014, oil collapsed really badly a couple of months later.
Right. So does that, yeah. Let's see what happens. I mean, the fundamentals are really important, but if you're if you want to keep it simple, just watch price action, what happens here, because the 2018 high is very important. Right now, we had 2 attempts to go back below it, and so far the buyers have defended that level on a closing basis. Today, we're testing that level again. So what happens today is going to be important, especially if we close below. If that happens, I think we're going to see a sharp sell-off in the days and weeks to come. At the moment, just to be clear, we are just seeing some bearish characteristics. It's not a full-on reversal yet.
Yeah.
As we are on the hourly chart. So just be careful not to
read too much into.
Yeah, exactly. Yeah. Short-term price action. It's just a warning sign. And also, before we move on from oil, last thing, the relative strength index is in the state of a negative divergence here.
Right.
At overbought levels. Okay, then I think that's all we had time for, haven't we, Victor? If there's anything else.
Yeah, shall we have a quick look at crypto?
Oh yeah, forgot cryptos.
Well, many people wish they have forgotten cryptos about 2 months ago.
Yeah, price action continues to favor the sellers.
Yeah.
This was previously a support that turned into resistance, leading it to a massive sell-off. Now we can move that line down to this area. And this one, we can move it to here.
Yeah.
So if whenever we go back above this level, we will have created our first higher high. Obviously, the distance between that level to where we are at the moment is massive, $10,000 to be precise.
It's about 50%.
Yeah. So maybe you could look at this in a different way and move this down to the high of this candle, because if you look at this daily candle here, this is a thrust candle that led to the breakdown below this, leading to a massive sell-off, right? So there's no reason for price to revisit that level, the high of that candle again, if the market remains bearish. Therefore, if and when we get back to that level, that would be a reversal, in my opinion. So you don't have to wait for a higher high, is what I'm trying to say. So that has kind of closed the gap a little bit, but still a massive distance from where we are. Have we seen a possible low in cryptos, Victor? Or are we about to?
Yeah, I'm not so sure about that, because if you look at Bitcoin's monthly chart, you see that it doesn't look very, sorry, not Ethereum, but Bitcoin.
Am I looking at Ethereum here?
Yeah.
Sorry about that. We were talking about Ethereum all along, not Bitcoin.
Yeah.
I kept calling it Bitcoin. And the reason we're looking at Ethereum, by the way,
you were talking about cryptos. You didn't mention which.
The reason I look at Ethereum is I'm personally invested in this one. Just to put it, yeah. So yeah, that's why I always go to the Ethereum chart first, more rather than the Bitcoin chart. But let's have a look at the Bitcoin charts as well.
Second from the bottom.
Second from the bottom. There you go.
Yeah. So yeah, if you look at this monthly chart, it's such a bull trap that we have. It's a huge bull trap. I have to say, like I haven't seen a bull trap like this in my life.
Right.
Because we after the sell-off in May, was it? Prices. Prices have moved back above the previous highs set in April, set up the bull trap. Many people came in, and I still feel like this market is full of people who are convinced that sooner or later we're going to go back to those 60 plus thousand levels. And I can't see this market going up before we clean the stop below 30,000, which to me is a dip to at least 20,000.
Oh, wow. Okay. Massive call there. And there's no reason why that can't happen, because, who would have thought a few years ago that cryptos would, Bitcoin would have reached 60,000, 20,000, let alone.
And let's look at this from the perspective of the government. So, and once again, I will bring up the Federal Reserve here, and those crypto people who are constantly saying, yeah, but the Fed will print money and we're going back to all-time highs. Yes, however, I'm not sure the Fed will print money for Bitcoin to go back to those levels. First, they're going to they'd rather see some pain on part of crypto investors to defer them from from taking this risk. Because the moment you start taking excessive risks, and there is no more excessive risk than cryptocurrency investing during this cycle. I feel like, the Fed, the last thing the Fed is going to do is to step in to prop up crypto investors.
Yeah.
And
so there you have it.
We have been, we have been seeing this anxiety creep in throughout last year. First with Elon Musk triggering the huge rally that we saw with his purchase of Bitcoin in January or February last year. And the other MicroStrategy and Square being other two companies that have piled their balance sheets into crypto. I just can't see why the Fed would be tolerating anything like this.
Indeed. Yeah, I mean, I kind of share some of your opinion with that regard. For me, also, it's about the investors are the kind of investors involved in crypto. They're not the same breed as the traditional markets, and some don't even care about what central banks do and say, or what the dollar does, or what yields do, right? Obviously, right now there's more institutional investors involved, so it's not the same anymore. But I think
so the market is starting to care.
The market's starting to care, indeed. But I still think that not so much as the other traditional markets. So for that reason, I am not too sure about what the impact of the Fed's policy is going to be on crypto prices in the long term. So that said, and given the size of the correction that we've seen, and the fact that the RSI is at oversold levels, I think that, and also if you look at the chart here, we are getting close to the base of the previous breakout in July of last year. So obviously, not many people saw this coming, right? So we have to take that into account as well. But we are at levels where, if you strongly believe in the crypto project, and if you still believe that prices are going to go higher, break to new highs eventually, then a lot of people will see this big sell-off as a very good opportunity to load up some longs after a 50% correction or so. As a minimum, therefore, I think that we will get a small rally from here. It's just a question of have we bottomed out?
50% retracement is a good point to have a rally.
Exactly.
No issues there. Like we could revisit 40,000 in a day.
Exactly. Yeah. So given that we have created this hammer candle and a possible false break below this candle's low that happened yesterday, it could be that Bitcoin has bottomed out here. Or as a minimum, we could see a move up to the 40,000, as Victor mentioned, because 40,000 was previously support. That level could turn into resistance. Who knows? But it is this area right here that is going to be very important resistance between 40,000 to 42,300. Any move above that would lift rates or lift prices, I should say, above the bearish channel, and that would be a bullish development in my view. So even if we get a small bounce, it doesn't mean that Bitcoin is out of the woods. We'd still need to get a breakout from the bearish channel for a full-on reversal to happen. So some positive signs here in the form of a hammer candle and a false break, and the fact that the RSI is at oversold, but it's not out of the woods. So if you are still if you're trading cryptos or investing in cryptos, still be very careful out there, because volatility is really high at the moment, and we could see even more losses. Who knows? But we have seen at least a glimmer of hope now with this hammer candle that was created yesterday.
Right. With that hopeful note, on that hopeful note, let's wrap this up and wish our listeners a positive balance at the end of this week. And stay safe out there, guys. This volatility creates opportunity, but also beware of the risks that it bears.
Indeed. Thank you so much for joining us. And for those of you who had tuned in, you were a little bit quiet today. Didn't see any questions from you guys, but hopefully we will in the next webinar. And for those of you who are watching a recording of this, please consider joining us live next time. We have this webinar happens every Tuesday, and every Tuesday of the week, 11:30 London time. The details of which is on the Think Markets website. So please consider joining us live. And if you like this video, for those of you watching a recording of it on YouTube, please like and share, as this will encourage us to produce more content like this. Thank you so much. Speak to you next time.
Thank you. Cheers. Bye-bye.
Bye.